SMX, Security Matters plc, is currently exploding to the upside, trading at $348 even, showing a staggering gain of $207, which translates to a 146.81% increase on the intraday session alone. When you see a stock more than double in a single morning, when you see a ticker symbol essentially go vertical on the chart, the immediate expectation is that they must have discovered a perpetual motion machine or announced a buyout by a trillion-dollar tech giant. The sheer violence of this move, pushing the price into the mid-hundreds, suggests a fundamental repricing of the asset. You expect this to be a clean victory, a simple story of a small company striking gold. But the reality of SMX is far more complex, far more technical, and frankly, far more dangerous for the uninitiated. The reality is that we are witnessing a perfect storm of financial engineering, a microscopic float created by aggressive reverse splits, and a sudden massive injection of capital that has forced short sellers into a corner from which there is no easy escape. This isn't just a rally. It is a liquidity squeeze of epic proportions, fueled by a $111.5 million financing deal that includes a very specific, very trendy twist, a Bitcoin reserve asset strategy. To understand why a stock that was struggling to maintain compliance is now trading like a high-flying tech darling, we have to peel back the layers of this financial onion. The primary catalyst igniting this firestorm is the announcement of an equity purchase agreement with Target Capital One, LLC. On the surface, this sounds like standard corporate finance, but look closer at the numbers. SMX has a market capitalization that, until recently, was tiny. A funding package of up to $111 million is not just a lifeline, it is a war chest that dwarfs the company's previous valuation. This creates an immediate cognitive dissonance in the market. How can a company be worth X when it just secured cash funding worth 5X? The market is frantically trying to solve this algebra in real time, and that calculation is driving the price to $348. But the cherry on top that is retail investors buzzing and algorithms chasing the bid is the clause regarding Bitcoin. The company stated it intends to use a portion of the proceeds to acquire Bitcoin as a reserve asset. In the current market climate, merely whispering the word Bitcoin in a press release is enough to trigger a momentum algorithm. SMX didn't just whisper it, they codified it into their financing strategy. This signals to the market that they are positioning themselves not just as a supply chain security company, but as a modern treasury-managed asset that hedges against fiat inflation. That is the narrative hook. But we must look at the structural mechanics of the stock itself, because why it is moving is just as important as how much. SMX has undergone multiple reverse stock splits in recent months, most recently an 8-for-1 split in mid-November and a nearly 11-for-1 split in October. If you are new to online investing or just opening your Schwab Intelligent portfolios, you need to understand what this does to a stock. A reverse split reduces the number of shares in existence to prop up the share price. When you do this repeatedly, you end up with a microfloat, a tiny number of tradable shares. Think of it like a game of musical chairs where you keep removing chairs until there is only one left. When good news hits a microfloat stock, there is literally almost no supply of shares for buyers to purchase. If 10,000 people want to buy, but there are only a few hundred shares available at the current price, the price has to gap up $10, $20, $50 at a time just to find a seller. This supply shock is the engine of today's 146% move. It is simple supply and demand physics applied to a tightly constrained asset. Let's pivot to the actual business, because beneath the financial engineering, there is a legitimate technology here that addresses a trillion-dollar problem. The expectation is that global supply chains are secure. You buy a gold bar, you expect it to be gold. You buy recycled plastic, you expect it to be recycled. The reality is that the global supply chain is a leaky, opaque mess filled with counterfeits, conflict minerals, and greenwashing. SMX addresses this with molecular marking technology. This is not a barcode or a QR code that can be peeled off or copied. This is chemistry. They use a proprietary chemical marker, a molecular barcode that can be embedded into raw materials like gold, plastic, rubber, or steel. This marker becomes part of the material itself. It survives melting, molding, and recycling. Imagine a gold bar that is melted down and recast into jewelry. With SMX technology, you can scan that jewelry and still identify the original source of the gold. This is the holy grail of circular economy tracking. It allows companies to forensically prove, that their products are sustainable. This is why their recent partnership with the Dubai Multi-Commodity Center, or DMCC, is so critical. Dubai is a global hub for gold trade. If SMX technology becomes the standard for verifying gold in Dubai, they are essentially toll boothing a significant chunk of the global precious metals market. That is the fundamental bull case, that SMX becomes the Intel Inside for physical materials. But we have to talk about the target capital deal structure again, because this is where the expectation versus reality tension gets sharp. Investors expect this money to be pure growth fuel. The reality of equity purchase agreements or equity lines of credit is that they can often be dilutive. The investor, target capital, gives cash in exchange for shares, often at a discount to the market price. If they turn around and sell those shares into the market to lock in their profit, it creates selling pressure. This is the double-edged sword. SMX gets the cash they desperately need to commercialize their tech, but the share count will likely rise over time, diluting existing shareholders. Today, nobody cares about dilution because the volume is so high that it absorbs everything. But 3 months, 6 months? That is the risk vector you must watch if you are holding this in a Fidelity brokerage account or an Interactive Brokers trading portfolio. You're betting that the company can grow its value faster than it dilutes its equity. I want to pause here and ask you guys to engage with this topic because it affects everything you buy. Comment below. Do you trust the recycled or sustainably sourced labels on the products you buy? Or do you assume it's just marketing fluff? I'm curious if you think technology like SMX's is necessary or if it's overkill. Let me know your thoughts on supply chain trust. Let's dig deeper into the Bitcoin reserve strategy. This is a move straight out of the MicroStrategy playbook. By allocating capital to Bitcoin, SMX is signaling that they believe the digital asset will outperform the dollar. For a small-cap company, this is a high beta strategy. It aligns them with the crypto supercycle. If Bitcoin rallies to $100,000 or $200,000, SMX's balance sheet expands automatically, regardless of how many molecular markers they sell. This turns the stock into a hybrid vehicle, part industrial tech, part crypto proxy. For traders using Robinhood stock trading or SoFi Invest, this makes the stock incredibly attractive as a way to get leverage on the crypto market without buying coins directly. But it also introduces volatility. If crypto crashes, SMX takes a hit on its balance sheet. You have to be comfortable with that correlation if you are long this stock at $348. The technical chart is currently in discovery mode. When a stock breaks out this violently, past resistance levels become irrelevant. We are in blue sky territory. The only resistance is psychological. Round numbers like 350, 400, 500. The support levels are equally tenuous. A gap up this large leaves air pockets underneath. If the momentum breaks, The fall back to $200 can happen just as fast as the rise to $300. This is why stop losses are tricky here. The spreads are wide, and the volatility can wick you out before reversing. If you are engaging in self-investing, you need to size your position small enough that a 20% drawdown in 10 minutes doesn't ruin your day. This is not a set-it-and-forget-it dividend aristocrat. This is a tactical combat zone. We also need to consider the short squeeze dynamic more closely. Before this news, SMX was a favorite target for short sellers who bet on the company's insolvency. The reverse splits were blood in the water for bears. They shorted the stock expecting it to drift to zero. Now, with $100 million in backing, the bankruptcy thesis is dead, at least for the medium term. Those shorts are now trapped. Every tick higher forces them to buy back shares, to